Inflation is a term that often makes headlines, but what exactly does it mean? And how does it affect our daily lives? In simple terms, inflation refers to the general increase in prices of goods and services over time. This phenomenon can significantly impact on a country's economy and the cost of living for individuals. In today's video, we'll focus on what is inflation, as well as the different types of inflation and the causes of inflation, including some of the consequences of inflation, as well as several measures to combat inflation. So, subscribe now, and let's discuss inflation and its impact on a country's economy, and how it further impacts the cost of living for individuals. Now that you've subscribed, let's get into today's video by discussing inflation. As an introduction, let us define what we mean by the term inflation. Inflation refers to a sustained and significant increase in the general price level over a period of time, and at the same time, a decline in the buying power of money. Think of it like this. Imagine you go to a bakery and buy a loaf of bread for $25. But then, you remember that last year, the same loaf of bread, at the very same shop, used to cost you $20. This is an example of how inflation erodes your purchasing power over time, meaning that the same amount of money buys less goods and services than it used to before. For example, if you had $100 last year, you could buy 5 loaves of bread at $20 each. But because the price increased to $25 per loaf, with that same $100, you can now only buy 4 loaves, meaning your money's purchasing power has decreased over this period. This is just a simple illustration of how inflation works. In more technical terms, inflation is referred to as the rate at which the general level of prices for goods and services rises, leading to a decrease in purchasing power. It is typically measured by indices such as the Consumer Price Index, or the CPI, and the Producer Price Index, or the PPI. The Consumer Price Index, or the CPI, measures the change over time in the prices paid by consumers for a basket of goods and services. Think of it as what you're paying at the checkout counter, or the till. While the Producer Price Index, or the PPI, measures the average change over time in the prices domestic producers receive for their output. The PPI offers a look at the change in prices at a wholesale level, often before goods hit the shelves. There are different types of inflation. In this next section, we will look at the following 4 types, which are consumer inflation, producer inflation, an all-inclusive inflation, and hyperinflation. Let's briefly discuss each of these types, starting with consumer inflation. This is also known as CPI, which measures the rate of change in prices of goods and services that are typically purchased by consumers. This includes things like food, clothing, transportation, and housing. Producer inflation is another type of inflation. This is also known as PPI. This measures the rate of change in prices of goods and services that are typically purchased by businesses. This includes things like raw materials, intermediate goods, and energy. Another type of inflation is known as an all-inclusive inflation. All-inclusive inflation measures the rate of change in prices of all goods and services for both consumer and producer. This is a broader measure of inflation than CPI or PPI. The last type of inflation we will look at is hyperinflation. Hyperinflation is a very high rate of inflation, typically defined as an annual inflation rate of 50% or more. Hyperinflation can be very disruptive to an economy, as it can lead to a loss of faith in the currency and a collapse of the economy. Inflation can be caused by various factors. In this next section, we will discuss these 2 factors, starting with demand pull inflation. This occurs when there is excessive demand for goods and services relative to the available supply. When demand outpaces supply, prices tend to rise. Another cause of inflation can be cost push inflation. This happens when the cost of production increases, leading to higher prices. Factors such as rising wages, increased raw material costs, or higher taxes can contribute to cost-push inflation. There are numerous consequences of inflation. In this next section, we will discuss how inflation affects the following. Starting with debtors and creditors. Debtors benefit because they receive money with a high purchasing power and repay their debt with money with low purchasing power. Creditors, on the other hand, may suffer due to inflation. Inflation also impacts on wage and salary earners. People with a fixed income will be able to purchase less as prices are rising. Another consequence of inflation can be felt by investors and savers. Assets with a fixed nominal value have a fixed return and lower purchasing power as prices increase. Furthermore, real value of savings also decreases. Inflation also affects taxpayers. In South Africa, income is taxed on a progressive system. Therefore, inflation causes what is termed as a bracket creep. This is when inflation pushes taxpayers into higher income tax brackets or reduces the value of credits, deductions, and exemptions. Bracket creep essentially results in an increase in income taxes without an increase in real income. Lastly, another consequence of inflation is the disruption of industrial peace, which is often caused by wage bargaining and usually accompanied by strikes and mass action. Inflation can also have both positive and negative effects on the economy. On the positive side, moderate inflation is often associated with economic growth. It can encourage spending and investment, as people are more likely to buy now rather than later, when prices might be higher. However, high inflation can lead to uncertainty and reduced purchasing power, which can slow economic growth and lead to a decrease in the overall standard of living. For individuals, inflation means that the cost of living increases. Essential items such as food, housing, and healthcare become more expensive, which can strain household budgets. If wages do not increase at the same rate as inflation, people may find it harder to afford the same standard of living they previously enjoyed. This can lead to difficult choices, such as cutting back on non-essential spending or finding additional sources of income. So, what measures can be implemented to combat inflation? Let's discuss that in our next section. However, before we continue, we'd like to take a quick moment to ask for your support. If you find this video helpful, please give it a thumbs up by clicking that like button below. And if you haven't already, consider subscribing to our channel. By subscribing, you'll never miss out on our latest content. Remember, hitting that subscribe button is free, and it shows us that you appreciate what we do. Now that you've subscribed, let's continue on today's topic of inflation by discussing the various measures that can be implemented to combat inflation. Let's start with fiscal measures. These are specific measures taken by the government, and particularly the Minister of Finance, regarding taxation and expenditure. These measures can include the following: an increase in direct taxation, such as personal income tax, which will help to decrease demand; an increase in indirect taxation, such as VAT, which will lead to a decrease in spending because goods become more expensive; a loan levy, which will ultimately reduce disposable income of consumers. The state could consider cutting back on expenditure by cancelling government projects like roads, hospitals, and schools. The state could also impose surcharges on imported goods. This will increase the price of these imported goods, resulting in many people being unable to afford to buy these goods. The country's Reserve Bank and the government can also apply certain monetary measures to curb inflation, including the following. The Reserve Bank can adjust the quantity of money to meet the needs of the economy through open market policy, thus maintaining a fine balance. The Reserve Bank can also curb inflation caused by excess demand by reducing the money supply. The Reserve Bank can also apply moral pressure on financial institutions to be more careful when granting credit. Excessive credit can also be reduced by restricting the granting of credit by banks. Additional measures that can be taken to combat inflation include the following. Increase productivity. This is a long-term measure generated through improved education and training, which allows more people to be employed and ensures they are more productive. Price control. By fixing the price of certain essential goods, the government assures they remain affordable. Wage policy. The government can also take a decision to break the inflationary spiral of increased wages and prices by keeping the increase in wages below or at the level of inflation. Stricter conditions for consumer credit. The government can also make it harder for consumers to get credit in order to restrict their spending. Encourage personal savings. As indicated previously, the government can implement measures to encourage savings, for example, by cutting taxes on savings. Relaxed import controls. The government and policymakers may also consider relaxing import control measures through tariff reductions, removal of import quotas, easing import restrictions, and entering into free trade agreements. Another measure to combat inflation is by using floating exchange rate. This is when prices are automatically adjusted to international conditions. Indexation. This is a policy of linking prices of items such as wages, pensions, and mortgage bond interest rates to price indices in order to eliminate the effects of inflation. These are just a few measures that can be implemented to combat inflation. If you can think of any additional measures, please let us know in the comments section. Just as a side note, we've noticed that most of the people who watch our videos have not yet subscribed to our channel. So, if you're enjoying our content, please support us by hitting that subscribe button. It really means a lot, and it also helps us keep bringing you informative videos. Just to recap on what we covered in this video. Inflation refers to a sustained and significant increase in the general price level over a period of time. This means that, on average, the prices of goods and services are rising, while the purchasing power of a unit of currency is decreasing. There are also different types of inflation. In this video, we looked at the following 4 types, which are consumer inflation, producer inflation, all-inclusive inflation, as well as hyperinflation. We also learned the various factors that cause inflation, including demand-pull inflation and cost-push inflation. We also covered a number of consequences as a result of inflation, and also learned that there are a number of measures that can be taken to combat inflation, including fiscal and monetary policy measures that the government and policy makers can use to fight inflation. We also listed other measures to be considered. Thank you for watching this video, and if you found it insightful, please check out these other videos under our channel. And don't forget to like this video and subscribe to our channel for more content. And remember to turn on the notification button on your phone to make sure that you don't miss out when we post new videos. You can also connect with us by following us on social media at Consult Kano, and continue the conversation by leaving us a comment or tagging us on social media. Join us again next time for another video. Until then, check out these other videos. Kano Consultants. For professional advice you can trust.